Lynn Alden, founder of Lynn Alden Investment Strategy, is back. And it's been a while, Lynn. Welcome back. Lots to go over today. The entire macro picture and your theory on fiscal dominance playing out. And we'll get your updated views on what's going to happen to the economy and markets alike now that we have not just a new Fed chair, but also supposed peace in the Middle East for now. Welcome back.
Oh, thanks for having me.
What would you say are the most significant events in the last 2 weeks for you that may or may not move markets into the remainder of this year? We'll start here.
Well, I don't think there'll be shocking answers. I think the kind of the partial resolution to the conflict with Iran, I think is obviously a key one, as well as the new Fed chair and kind of communication that they've done going forward. So yeah, I think those are probably the largest things. And the reason I say, of course, kind of the partial resolution is that, I mean, it's only a memorandum of understanding. So I think we're still going to have headlines in the coming weeks and months. But it's at least headed a much, at the moment, more positive direction than it has been for many months.
The economists I spoke to this week pretty much unanimously all projected higher interest rates in the long end of the curve as well as the short end to varying degrees. Because of the new Fed chair and because of inflation expectations and because people are expecting the Federal Reserve now to raise interest rates this year rather than cut. So my question is, even if monetary policy didn't change from last year, would interest rates on the long end still go up because the deficit has increased and so the debt has widened as well?
I think it's a little more complicated than that. I think there's a lot of moving parts on the long end of the curve. There's obviously expectations around what inflation is going to be. There's sheer amounts of supply hitting the market compared to what is that existing balance sheets are willing to buy. There's even geopolitical decisions sometimes, like are international buyers on strike or are they accumulating? And from 2019 until a year or two ago, I was kind of on the record of being a pretty structural bond bear, meaning that either combination of higher yields, meaning bond prices down, or even just sideways yield and not really keeping up with debasement. But once we got to like a year or two ago, I view them more as kind of a neutral, unimpressive trade, which is that I don't try to anticipate, 50 basis points moves in either direction for the long end. I mean, in general, if the market expects that the Fed's going to be a little bit more hawkish than they did a week ago, it makes sense that we've seen some curve flattening, which is that, of course, they're a little bit more hawkish on the short end. And they're a little bit more comfortable with the long end. But these things can change very quickly. And I think one of the key factors that I think the market still doesn't fully appreciate because the market is so trained to think that the solution to inflation is always higher rates. That's kind of the main lesson from the 70s, or at least like that's the biggest takeaway from the 70s, early 80s. But that was in an era where most of that money creation was from bank lending. And interest rates are a very powerful tool for curtailing or and sometimes accelerating bank lending. But when you're in fiscal dominance, when fiscal deficits in a given year are bigger than net new bank loan creation, interest rates don't do quite as much for that because every time they raise interest rates, while they could put some downward pressure on bank lending, they actually blow out the fiscal deficit even more. And so they're in it's a challenging position to be in if you're the Fed, because as the chairman pointed out, their current levels are already restrictive on housing, and yet we still have above target inflation, and it's because it's not really bank lending.
Just summarize for us one more time, please. What does fiscal dominance mean in this context? In an era of fiscal dominance, what role does the central bank play?
Right. So basically, fiscal dominance, it can take a few different forms, but it's essentially when you get over like 100% federal debt to GDP, you've got a very big stock of existing debt. And if we in the U.S. we had kind of a 40-year period of rising debt to GDP, but it was offset by structurally declining interest rates until we hit roughly zero. And now that we're trending, sideways in interest rates, and we still have the high debt to GDP, we no longer have that interest rate offset. And so now interest expense has outpaced defense spending. And there's really no clear resolution to this. It's just like it's going to be an ongoing large part of the federal deficit going forward. And there are techniques to deal with it, including financial repression. You can do yield curve control and submerge the whole all the debt below inflation. But then you have generally accelerated currency debasement and higher levels of inflation. And so the answer to the second question is, what is the role of the central bank? Their role is diminished, right? So in say the 70s and 80s, we can call that a period of monetary dominance. So you had low debt to GDP. Deficits while they were there, especially in the 80s. They just weren't the driving force on money creation as it is now. And so going forward, the Federal Reserve, they still have all their major roles in bank regulation, basically oversight of the banking system. I mean, that remains unchanged. But their two primary tools of interest rate decisions as well as balance sheet decisions basically become less impactful, and their option space like narrows, because instead of saying, okay, high inflation because banks are lending too much, let's raise rates. It's clean. But if you have, hey, inflation's up because we're running structural big deficits, and we had a war, so like energy was elevated for a while, and you say, well, let's raise interest rates in response to that. What exactly are you doing? Because you're not. I mean, the government's not going to spend less. If anything, they're going to spend more because you just increase their interest expense, and you're still having the similar effect on bank lending, which is the marginal borrower might be more conservative because interest rates are going up, but that's already not really the core issue anyway, and that's how you get this kind of two-speed economy where if someone's like a young family looking to buy their first home with a mortgage, without help from say their parents, they're in a world of hurt right now. It's practically unaffordable. Whereas the deficits are primarily going to Social Security, Medicare, defense. Obviously, wealthy individuals are doing very good, and so you get this really polarized economy. And the answer is that the Fed's not really designed for fiscal dominance. Like this is kind of the breakdown scenario, not in the acute sense, but in terms of policy effectiveness. Fiscal dominance, like the tools are geared toward areas of monetary dominance.
Before we continue with the video, let me tell you about a very important topic, which is your personal information. Now, your personal privacy is of utmost importance, probably even more so than your personal assets. And your personal information is likely online right now. Your full name, home address, and phone numbers are sitting on data broker websites that anybody can access or buy. I bet you probably didn't know that. So that's exactly why I use Delete Me. Our sponsor today, Delete Me, removes your private information from hundreds of data broker sites, and since June 2024, it's removed 204 of my listings, and my latest report shows 335 listings were reviewed last month. That's what I like. It's consistently and constantly checking so nothing slips through. Getting started is straightforward and easy. Just submit your information, and in about a week or so, you'll get a report showing where your data was found and what was removed. And it doesn't stop there. Delete Me keeps scanning the internet and removes your data throughout the year. So go to joindeleteme.com/David Lin, link in the description down below, or scan the QR code here and use my promo code David Lin at checkout. New users who use my code will get 20% off of all US plans. Take your privacy seriously before somebody else does. Recent news now. At the G7 summit earlier this week, the signing of a peace deal with Iran was concluded for now. Temporary peace. We'll see what happens in a few months. But Trump argued that the reopening of the Strait of Hormuz may have prevented a major global economic shock, called it a catastrophe that was avoided. How accurate is this statement?
Well, I think in the longer term, that's relevant. I mean, we've already seen some shocks. I think many people, including me, have been surprised at how resilient the world has been to a closure of that much oil hitting the market. The biggest factor ended up being that China was a lot more flexible than many people thought in terms of greatly reducing their imports, being willing to draw down their large and opaque inventories. And that was a much bigger offset. And I think another thing that surprised people is that, energy's been kind of choppy for a while. And so it's interesting that President Trump kind of cited that now, because I don't think that we were like near term compared to any sort of like, economic disaster from oil. I think that the more kind of pressing one is just optics of the situation. Uh, Probably a political kind of somewhat separation between the U.S. and Israel's interests on this, and kind of increasing realization of that. It's been a very unpopular war from the start in terms of polls compared to most other wars when they begin. It goes against campaign promises. We have midterms coming up. But there's some of those reasons he can't realistically cite. So I think he has to point to other ones, and he's pointed to stock market, he's pointed to oil, and so I think that's yeah. There's a lot of reasons for him to have eased out of the war, and he'll cite the subset that is less damaging.
Okay, I'll play for you a short clip, and we'll evaluate this together here. This is Trump speaking at the G7 summit.
300%. They have no money. We have tremendous leverage. We have the leverage of the economy, as an example. We'll get that done. That's a small one, and we'll work with Israel and get it done. But I'd like to do it. I mean, you have people living there. Buildings are being dropped on top of them or right alongside of them. $1 billion worth of bombs on Iran. The blockade was so incredible. The naval blockade, the admiral, the whole thing, not one ship got through. That meant no money got through. They were dying. They had no money. They have inflation that's 250 or 300%. They have no money. We have tremendous leverage. We have the leverage of the economy, as an example.
Here he's talking about leverage against Iran. What leverage did the U.S. actually possess against the Iranians in this particular case?
Well, largely what he said. I mean, we obviously, the U.S. killed their leadership structure. So we have military leverage, as well as, economic leverage. I think the challenge is I think they miscalculated the relative leverage, because, their leverage against us is not as direct. I mean, they can't just blow up our cities. But they can affect his midterms, for example. They can affect consumer sentiment in the U.S. with higher energy prices. They've been putting out like memes. They have a cultural leverage and kind of things they can do online about kind of just the reasons for the war and why we're there and who's all of that. And so I think that unlike Venezuela, which was obviously a very swift operation, I think built U.S. confidence that they could just kind of do this to any country. Iran demonstrated that they have a really kind of deep, decentralized bench of leaders that can come back up after other top ones are taken out. They've shown that their technology is pretty resilient. Their ability to do drones and missiles and to avoid having their capabilities disrupted to do that. It just kind of shows that the cost for the U.S. on this is very significant. And partly is, I mean, technology changes over time. For the better part of the past century, the carrier group has been the primary form of power projection. I mean, aside from nukes, when you actually need targeted power projection anywhere in the world, the carrier group is the main force of that. But they don't work that well against asymmetrical, cheap threats like tons of drones, tons of missiles. And of course, the U.S. naval blockade was effective. I mean, not that people doubted that the largest navy in the world could block that area because they don't have to be close to it. They can stay farther back, and if they just identify ships that come out of it, they can stop them later. So the U.S. Navy, in many ways, had to stay far away for safety. But yeah, they can still do a blockade. But by doing so, I mean, the bigger issue is Iran was blocking other countries from exporting their oil. And ironically, the U.S. blockade was also blocking other countries, including allies, from getting oil through. So a lot of this is just like a scramble almost to get back to where things were before the war began, or kind of more broadly back to the previous Iran deal, which is when Iran was not enriching uranium, and it was allowing international inspectors to come in and verify that they weren't. And so a lot of it is nearly a decade now, almost trying to get back to what was already working.
Okay, here's another clip. This one's key here regarding inflation.
How do you see this agreement further affecting energy prices in the U.S. and the U.S. economy in the long term? And secondly, Mr. President, how do you think Vice President J.D. Vance did on The View yesterday?
Well, first of all, thank you for the word plummeting, because that's what's happening. Oil prices are plummeting. And that means oil prices are going to come down. If you make donuts, you have a heating, you have a stove, and you have to buy the heat. You need the gas or the electricity or whatever you're using. And when oil prices come down, oil is the biggest thing. Oil is, you get oil prices coming down, and they're going to come down. And we're hitting into threes now for gasoline, and that'll come down a lot lower. So I was in Iowa just before this started, and I was saying to myself, I can't believe we're doing so well, but I have to go, and we have to put out this fire in Iran because I don't want them using a nuclear weapon. They would have used a nuclear weapon. 100% they would have used it.
We'll stop here. Notwithstanding the nuclear weapons comment, let's talk about the inflation part. His thesis that oil is coming down, and therefore the rest of inflation will come down. That's the subject of great academic debate. What's your opinion on that?
Well, a couple things. One is, so if we're assuming the memorandum of understanding and the ceasefire remain in effect, so if the industry does open, for the most part, that should be a kind of a bearish force on oil, which is good for the world. And even just not having oil rise anymore, if it just stays where it is and just chops around, at least it's not rising in that environment. And that allows kind of month over month, year over year measures of what's going on to cool down. Now, whether that will lower other prices, that's more contestable. I mean, obviously, commodities are very volatile. Other prices tend to be more kind of, they ratchet up, but they rarely ratchet back down, unless it's like a super deflationary area like technology, like electronics and stuff. But most prices, they slowly ratchet up. Not usually as quickly as oil and gas, but they ratchet up, including in response to higher energy prices. And if the prices come back down, usually those prices are stickier. And generally, when people talk, especially when politicians talk about prices coming down, they really mean the rate of change of prices going up is reducing. And so I do think that, the obviously the sharp increase in inflation we've had, there's been a couple of reasons for it, but energy's been by far the biggest factor. And I do think, again, as long as the ceasefire continues, that should ease in the back half of this year, that we no longer have that kind of rising inflation that we saw in the past few months. And there's really no signs that we kind of have a breakaway inflation like we saw in 2021, 2022. Because we don't have the money supply growth of that era. We still have money supply growth, but we don't have like the 40% year over year increase in M2 that then trickled over the next several years out into the economy, out into prices. We have kind of a fairly normal rate of money supply growth at the moment. And so I think inflation's still probably going to be stickier above 2%. But I think it could be correct that it goes kind of sideways to down in the coming months.
Does the market share that view, Lynn? Looking ahead, the CME Fed Watch tool is projecting a near 85%, it's 90 now, 90% chance today of at least 125 basis point rate hike by December. So 10% chance rates stay where they are, 90% chance they raise rates. If inflation expectations are to curb a little bit somewhat, like you said, later in the year, why are expectations for a rate hike higher and higher throughout the rest of the year?
Well, you'd have to ask all those that are making that case. I think I would say that while a chance of a rate hike is pretty meaningful this year, I think 90-10 is a pretty aggressive position on that. I'd be a little bit more split on neutral to one hike. And of course, the two conflicting issues there. One is that because inflation is above target, and it's been rising recently. And the Fed made it clear that they are, they're emphasizing the price stability side of their mandate, not the unemployment side at the moment. That they do have, kind of an interest in potentially raising rates to try to bring down inflation. Now, again, from our earlier kind of talking points, I mean, when you have a war or you have fiscal dominance, interest rates are not necessarily the tool that fixes that, but it's a tool that they have. So if you have a hammer, you use the hammer, even if it's not the best tool. But they've also, like in the Fed chair's recent Q&A, he talked about how they care about trending numbers. So in a month or two, if we start to see this current inflation wave crest, because if oil prices stop going up, if the Strait and just for the most part peace in that region allows energy to flow, the Fed could conceivably say, well, okay, inflation's above target. We're still restrictive on housing at current rate levels, and it's inflation's rolling over, so we're not going to be super aggressive. Now, again, one hike in either one hike or one cut is not that big of a driving force, and I just think that it's for me it's almost irrelevant. I mean, obviously it obviously impacts if you're a levered short-term bond trader. And things like that, or you're trading interest rate futures and things like that. It's obviously very relevant. But if you're an equity investor, or a gold investor, or a real estate investor, even just an unlevered bond investor, if you're doing things like that, 25 basis points is not a massive thing to focus on, in my opinion.
Mm-hmm. Do you think the U.S. would have gone into a depression had the Strait of Hormuz remained closed? Take a listen to this clip.
But so are we. So rather than possibly going into a depression, rather than having your favorite president be Herbert Hoover, I was always the one I didn't want to be. I wouldn't have preferred Nixon. I wouldn't have preferred, there are plenty I wouldn't prefer, but the one I always thought of, Herbert Hoover, and he caused it. He raised taxes too fast, and he raised interest rates too fast, all at the same time. And it caused the Great Depression.
Okay, 2 points there actually I want to make. The idea that had the Iran deal not been made, the economy would have gone into a depression. And then he referenced Herbert Hoover, who a lot of people associate with Smoot-Hawley, and that, according to some economists, arguably caused the Great Depression. And now he's arguing he raised interest rates and taxes too quickly. What actually caused the 1930s Great Depression, and can the same parallels be applicable today?
Well, I mean, we could have a whole show on that. What caused the Great Depression? I mean, there's tomes written on that. The short answer is that was it was a private debt bubble, right? I mean, it goes back to World War I and before, because you had all this money creation, all these kind of broken gold pegs, attempt to get back on gold pegs, even though money supply was grown, and obviously with international commerce between Europe and the U.S. We had that boom in the 20s in the U.S. And throughout that decade, we got very high private debt levels relative to GDP. Banks are very levered. There's a ton of speculation in the stock market, and it all popped. And then there's other factors like the Dust Bowl, like literally bad agricultural practices. It's way easier to go through a Great Depression leverage wise if you don't also have agricultural failures and things like that, and just kind of that extra misery. But basically, primarily the issue was that private debt bubble, and then when you add on to it a president that was kind of focusing on tariffs and kind of just generally anti-trade types of policies, I would say certainly didn't help the situation. I wouldn't say that that handful of things just kind of like things were fine and then he did those things and it caused the Great Depression is not how I would characterize it. I think that the leverage and the speculation in the years leading up to it was the biggest factor. But then it was all these attempts on, what do you do once that starts to pop? Now, bringing that to the present, when it comes to depression, I mean, by some metrics, I would say that 2008 was our 1929 scenario. That was our generational peak in the private debt bubble. So private debt relative to GDP, private debt relative to money supply, the ratio of how levered banks are, all of that peaked in that 2008-2009 period. We've kind of rotated more from a private debt bubble toward a public debt bubble. That's kind of where we've kind of started shifting toward fiscal dominance. Now, of course, we went through it in an environment that was not as deflationary because they were much quicker on the money printing trigger. And we're in a different technological environment, no crop failures. It's easier to go through a Great Depression when you have, computers and things like that. So it was a different environment, but it was similar in that we hit zero interest rates, we hit a private debt bubble, and then we had just years of debasement and rotation toward the public debt. So the long-term debt cycle that I've talked about before. And then, so would this have caused the Great Depression? Well, by some metrics, I mean, for example, consumer sentiment during the war, U.S. consumer sentiment was literally at record lows. I mean, it's been measured since the 50s and hit record lows. And people can talk about whether it's still an accurate measurement or not, but the way that they measure it, it hit record lows. We have obviously very high public concerns around cost of living, around just kind of the expectations that the next 5 or 10 years are going to be better than they are now, or the expectations that things will be better for their children than they are for them. A lot of that is, or just trust in media, trust in government, trust in, all the kind of institutions. That's all very low. So a lot of that is kind of in that kind of depressionary type of thing, that economically depression. I wouldn't go so far as to say that the strait remaining closed for another few months would cause what many people would look at as a U.S. depression. I do think that it would have been ongoing issues once we can no longer draw down U.S. strategic reserves, once China had gotten pretty low in their drawdowns, once commercial inventories were pretty drawn down. That's when you start to risk $150 plus oil scenarios. The countries I think that would have potential depressions in that scenario are the kind of the frontier markets, the lower income developing countries that are more likely to face energy shortages if that happens. I mean, for example, Egypt in April had to do an energy curfew. Probably, if you look at some economic figures there, they had almost like a mini depression because you literally were shutting down parts of the economy for every day. But because it was short lived, you could bounce back from it. But if you got into a more persistent shortage, that would be an issue for many countries. Less so for the U.S., but again, long enough, you could have $8 gas prices and very big economic problems.
Okay. So, Lynn, ultimately, the assets that will perform well and not perform well in this kind of fiscal dominance environment, in particular, after a ceasefire has been reached and after the FOMC has shown signs and signaled that they're willing to tighten monetary policy even further. Your take on asset allocation for 2026?
Roughly the same as it has been. I have a strategic allocation, which is just high quality equities, basically equities that are not in a bubble, growth at a reasonable price, sometimes value. I think gold obviously took a hit. Whenever you have the market perceived that the Fed's going to be a little bit more hawkish, you generally get a little bit of a sell-off in gold. The issue there is that gold had a really, really powerful 2-year run. So I do think that it has to build a new base. Some bears would say gold's going to round trip, all of its gains from 2024, 2025. I wouldn't be in that camp. But it did rise really quickly. A lot of the asymmetry was taken out of the trade. And I think it has to kind of find a bottom and build a new base. So I'm not jumping into gold as a trade, even though you still have just a permanent strategic position in it. So for me, a lot of the interest right now is in equities. I think Bitcoin's still in a very kind of low sentiment area. It's not getting any favors at the moment from a hawkish Fed, similar to gold. But once that starts kind of forming a bottom and a longer base, I think that's an interesting kind of 2-year trade or longer. But for a lot of investors, I think the core of a portfolio makes sense to be equities.
Let's just go over each asset by asset. Let's just go over analysis each asset by asset. Gold has come down significantly from its highs. Is that an indicator for future market movement with the rest of the assets, or is gold moving independently, do you think?
Look, I would characterize it as relatively independently. I mean, kind of like how its 2-year burst upward was independent from many other types of assets, at least in terms of magnitude. I think there's been geopolitical reasons for it. It's in fiscal dominance, generally precious metals do pretty well. But again, it got over its skis. A good asset can get over its skis when you have relative strength index, sentiment levels and things like that getting really high. It's generally going to go in the other direction. And again, some people would say, okay, it's radically overvalued here. I wouldn't go that far. When it got up to 5,000 an ounce, for me, it was no longer cheap. And it was, kind of back up to something that looks like fair value. But it had gotten there so quickly that there's risk there. So I think that most likely, gold's going to trade how gold's going to trade, which is, I think it's going to wander around. And from a tactical standpoint, I want to see it kind of put in a base before I'd be pounding the table on buying it again.
Bitcoin, you're still doing work with Bitcoin. Bitcoin also has fallen out of favor, not just in terms of price, but also in terms of market sentiment and investor sentiment. Surely you've noticed that as well.
Yeah.
Again, Bitcoin moving independently or indicative of broader risk-off sentiment ahead?
I'm not sure I would put it in indicative. I think basically a lot of I think there's two big factors. One is that the broader crypto space, which I'm pretty structurally bearish on outside of Bitcoin and stablecoins. I think it's finally just seen throughout the market that narrative doesn't have as much legs as people thought it did. A lot of it was kind of fake decentralization. A lot of it was regulatory arbitrage, and that there's really not a lot of there outside of hard money. Stable coins, tokenized gold, tokenized equities. I mean, real world assets, that's still fine. But generally these other crypto things, DeFi, NFTs, ICOs, that kind of thing, is just in general, it's not as big of a market as people thought. So I think that industry is kind of gradually stagnating. It really has been stagnating since 2021. Like DeFi total locked value never really took out its 2021 peak, for example. So I think that Bitcoin has that whole kind of broader thing weighing down on it. And then obviously there's been concerns around some of these levered Bitcoin treasury companies, which sometimes I think are overdone, but some of those are valid concerns. I mean, anytime you have leverage, I think it is worth paying attention to, how they're managing risk. And then the other factor is that a lot of investors that kind of viewed Bitcoin or broadly crypto as the fastest horse in the race have shifted toward AI. So just the sharp rise in chip stocks, in hyperscalers, obviously the SpaceX IPO, that's pulled a lot of capital that is otherwise, maybe seeking, kind of viewing Bitcoin and crypto as tech, has been pulled in that direction. So until that kind of cools off a little bit, I think Bitcoin could be some pressured. But I think Bitcoin's fundamentals are still good, and it's kind of in the bottom, 10, 15% of its kind of historical. There's different ways to measure value for it. For example, market cap compared to on-chain cost basis and things like that. Other sentiment indicators. It's kind of near the lower end of a lot of its historical indicators.
Do you think the same investor base that flowed into crypto has now rotated into the AI space?
I think partially, yeah. But I think obviously AI is sucked in a lot of pools of capital. I think that it's not like just the crypto space went into AI. It's like a lot of pools of capital went into AI, yeah. And I would say, yeah, a lot of investors that were excited by digital assets throughout the 2010s and early 2020s have there's a new set of tools to either build on or invest in. So I do, yeah, a lot of it has kind of rotated in that direction, which I think is healthy because again, I think the broader crypto space, I just think there's limits there to what it can do.
Okay, so when someone asks, well, is AI in a bubble right now, and should we stay away from that? That's a very loaded question that has a lot of moving parts. How would you go about tackling that question? Like, what's the thought process in evaluating if an entire sector, by the way, Elon Musk himself is now worth about the same as Canada, I believe. No. Half of Canada. SpaceX at some point was worth Canada's GDP. So an entire sector that is several times the GDP of many G7 nations around the world, is that in a bubble? How does one go about answering that question?
I think ironically the answer could be similar to gold, which is, so gold had that crazy 2-year run, and the question was, is it a bubble? And I would say, well, I wouldn't call it overvalued. I just think it got here kind of too quickly for comfort. Yeah. And so it's likely to correct, form a higher base, and then it can recover from there. I think AI is similar, which is that I think a lot of the tech is real. I think it is a pretty big productivity gain in a lot of cases. Any sort of technological shift often has waves of getting overbuilt or overvalued. Famously the companies that laid the fiber optic cables like go bankrupt, right? I mean, it's not that we didn't need those. It's great they did that, but it was very expensive, and they kind of overestimated how much front running would happen, how much growth would occur. So, I do think that's when SpaceX trades at 100 times revenue, it's excessive. I think that there is real risk with the hyperscalers because a lot of them are free cash flow negative now. The primary AI models OpenAI and Anthropic and all this, they are VC funded. They're highly unprofitable, so they're subsidizing usage of them, meaning that the demand we see in AI now is partially because they're making it cheaper than it really is, because they're trying to get growth. Which makes sense when you're in that growth arc, but it's kind of like how Uber was growing very quickly because it was underpriced, but once they started pricing it at a more balanced level, demand kind of eventually slowed down. So I do think that parts of AI are way ahead of themselves. I've been a little bit more bullish on the chip stocks than others, than like other parts of the AI trade. Because I do think, for example, we are going to just persistently use way more GPUs than we did 5 years ago. We are going to persistently use way more RAM than we did 5 years ago. But again, things can move a little bit too quickly. So I think the AI trade is heated. I think parts of it are bubbly, like SpaceX. But whenever it does kind of cool off or consolidate for a period of time, I always kind of go fishing in that market and say, okay, what is kind of sold off, but is still doing great numbers.
Okay. Is this part of the plot of your new sci-fi book, by the way, that I believe is out, the Stuttgart Incident? People should note that Lynn is a talented fiction writer as well. We'll close off here. Anyway, this book examines the future. Yes.
Yeah, people should check it out. And I would say that one of the reasons I wrote it, because I had that story in my head for a long time. AI exists in the book, and basically technology was kind of catching up to some of the technological stuff in the book. So I was like, if I don't get this out now, it risks becoming historical fiction. It was a fun project to work on, and people seem to like it.
How do you envision, and this is, I guess, where the writing of science fiction gives us a lot of flexibility to use your imagination. How do you envision the world to look like in 50 years with the advent of AI and the advancements in robotics?
It's a good question. I think when I write the book, it's like the first part is just to entertain and make people think, and the second one is, as a former engineer, I do try to get predictions at least directionally, kind of making some sense. The book kind of assumes that VR, virtual reality, eventually gets a little bit more popular. That's been a slow technology to take off. They kind of even remark in the book that it took a long time to take off, but they finally kind of figured it out. I think that just AI and to some extent robotics is it's just kind of a background prevalence in the book. So in the book, people do still have jobs. They still work, but generally a lot of people's work involves working with AIs as well.
When you say virtual reality, do you mean, sorry to interrupt, do you mean like physically in a VR space with a headset or in a hologram, or do you just mean interacting digitally like you and I are now?
The former, like Ready Player One. I mean, not that extreme, but like basically, yeah, that there's more visual technologies, either in terms of augmented reality or virtual reality, that are just around the margins more popular than they are now. But yeah, that's kind of the ubiquitous of AI, just kind of as part of our lives. The book does take I guess some might call it bearish take. I mean, it's less bullish than like the utopias, which is that it kind of assumes that AI does run into certain limits at certain points, and even some characters articulate why. So AI becomes incredibly productive, but kind of like how aerospace, the aerospace industry, we went from Wright Brothers to the Apollo program in the course of one human lifetime. And then we kind of stalled. Like we don't really have faster commercial flight than we had 50 years ago. Until the cool stuff with SpaceX, we're not doing as much in space as we were decades ago. We kind of flatlined. We ran into certain ceilings, and our improvements were more incremental. We added wingtips to commercial planes, which gave them more fuel efficiency. We most of the changes were in their electronics, not their actual aerospace aspects. And I think AI probably goes to a similar dynamic, which is you have this kind of takeoff scenario, just radically more productive, more useful, changes the way we do things, much like aviation did. But then it kind of hits not a hard ceiling, but like a softer ceiling where a lot of low-hanging fruit is picked now. Combination of Moore's law, combination of just, what a large language model can do, compared to a conscious brain, and that it becomes a valuable but not invincible tool.
Okay, excellent. Well, I look forward to reading that. I like sci-fi and I like your work, so curious to see what the characters are up to, and if the terrorist is caught, won't spoil that surprise. It's about I think it's a detective in the future looking for a terrorist, I believe is the summary I read on your webpage. So that sounds pretty interesting. Okay, thank you very much. Where else can we learn from you, Lynn, and study your work?
LynnAlden.com. Thanks for having me.
Okay. LynnAlden.com. We'll put the link down below, and her X as well. Put that as well. Thank you very much, Lynn. We'll speak again soon. Take care for now.
Bye.
Thank you for watching. Don't forget to like and subscribe.